Hey climbers, welcome back to Climb by VSC, a weekly show about building and scaling startups in the world of climate innovation. My name is Vijay Kapoor, general partner of VSC Ventures and co-host of Climb. Every week, I or a member of our VSC team will speak with a pioneer in the climate tech world about emerging technologies and novel ideas that will turn the tide on climate change. We've all heard enough of the doom and gloom. It's time for stories of purpose-driven innovation that lead to sustainable, positive change. As always, I'm so happy that you've decided to join us. Now let's climb.
Welcome to another episode of the Climb podcast from VSC Ventures, where we bring on company builders and folks that are helping scale businesses in climate technology. Today, very excited to have on Ian Rountree, founder of Cantos, an amazing and important venture firm that's investing in some of the most complicated and complex businesses and technologies out there to solve some of our biggest problems. I think Ian can say it better than I would, but I do want to introduce him. I had a chance to get to have dinner with him about a month ago. Excited about what you're excited about, Ian, and excited to share that with our community. So with that, thanks for joining and looking forward to getting into it.
Yeah, I'm excited.
Awesome. So let's start with your background. So you have an interesting background to get to Cantos. I've seen just from your background and really, I guess my question is, how did you get from like SoFi, which it's sort of fintech and financing, into deciding to go into Cantos? And again, maybe I missed something as I was looking through LinkedIn, but would love to also just understand that sort of your career trajectory, and maybe even if it started before SoFi.
Yeah, no, definitely. There was my background is sort of nonsensical and circuitous, and if you looked at my LinkedIn, you'd be like, "What? This guy's a deep tech VC? Like, what's going on here?" And honestly, it didn't all make sense to me at the time. I think a lot of things aren't apparent until after the fact, right? And the through line for me was always trying to find my place in the world, in like that kind of gestalt sense. Like I wanted to do good in the world. I didn't necessarily know the best way for me to do that. And I studied political science, started pre-med, then thought maybe I'd work in public health or something. Went and worked for a nonprofit in Central America after school, then went into healthcare consulting when I got interested in sort of business as a way to affect change in the world. I was really interested in impact investing and social entrepreneurship. Had always been kind of a sci-fi nut, future forward person given my mindset. And so in 2012, quit my consulting job, moved out to San Francisco. Was one of the early employees at SoFi on their capital markets team. Also did some BD marketing, but I was sort of the in-house like banking analyst, and did some fundraising for their student loans at the time, which is when I got interested in investing and sort of brokering capital with innovation, and set my sights on business school. Couldn't get in. So my consolation prize was investing my savings in 11 startups, figuring I'd lose it all, but learn a lot. And parlayed that after a couple more startup jobs into Cantos in 2016.
Amazing. And so tell me about that experience with those first angel investments. How many did you do? What did you learn? What got you to the point of, okay, you've seen enough that you want to start a fund?
Yeah, I mean, I made 11 investments over, this was kind of 2013 to the beginning of 2016. And I mostly learned what I didn't know and what you can't know in the early days. And venture investing is, I think, more than any other asset class, dealing with uncertainty. And, I was, of course, overly confident initially, and I thought every company I invested in was going to go to the moon. And I learned the power law most of all, which is that, the way that those 11 investments played out was that one of them, within a few years, I was able to sell in the private markets. This company's not gone public or anything, but sold for 20 times my investment. And that was one of the larger ones. And so it returned kind of 4 times the total invested capital. And haven't seen anything from any of the rest. There's like a couple that are doing all right, but what I learned is essentially like you make 11 investments, only one really matters. And so thinking more probabilistically is probably the biggest hurdle that you get over, at least if you're coming from other asset classes where there's more risk aversion and you sort of have to like make sure that everything, the median investment is very good. Venture is fundamentally different. The probabilities are so skewed.
How did you get that deal flow? I mean, if I think about your job at SoFi, I wouldn't think that you're running into these kind of founders on a daily basis, but maybe I'm wrong. Like, how did you, was it like just two different worlds you're living in, daytime and nighttime, or like, how'd you do that? Or was it before that actually?
I was young and single and had just moved to San Francisco and I wanted to meet everyone who might be interesting, and was going to happy hours and dinners and, you know, weekend getaways. And the founders of SoFi had gone to 4 of the 5 had gone to Stanford Business School. And so sometimes they'd have their friends over and their friends were, you know, starting companies. And it was really happenstance. And I don't know, maybe it was easier back then. Like, I mean, I was writing tiny checks, so it wasn't like the allocations mattered. It wasn't that competitive, but, and we can get into this, but it certainly like from 2013 to 2017, that phase was when it felt like angel investing, starting your own small fund, really dramatically popularized.
Yeah.
And that sort of changed how I was thinking about things. And then, you know, Cantos 1 was much broader in scope. I've again always been motivated by how do we do good in the world using technology, but it was more broadly defined. I was okay with sort of adjacent, like bank shot impact type pitches. And over time, one of the reasons I got more interested in deep tech was that I felt like there was a more direct line to impact when you were building stuff in the real world, but also because venture had gotten much more competitive, and I knew that we'd benefit from some specialization.
Yeah, makes sense. And now, so Cantos 1, how big was the fund? How many companies did you do out of it or still doing out of it?
Honestly, at the time, like I had run out of my savings, and I was working at a startup and we were pitching VCs, but, you know, I was kind of realizing that I'd rather be on the investing side than at that startup. And the CEO and I had, you know, sort of a difference of opinion of which way the business needed to go. And I was realizing as we were pitching all these VCs, like we did 80 pitches, and I remember 4 of them fondly. And I always kind of like held VCs up on a pedestal, and I thought it was this like magical title that if you were a VC, you were automatically, you know, some genius worthy of you know, tremendous respect. And that experience really disillusioned me about that. And I realized that, yeah, there was a lot of money in VC, but it was kind of hard to find people that had founder empathy and got back to you quickly and were, you know, smart and kind. And I started talking to folks saying, look, I met a lot of VCs and founders. I'm pretty sure I could get the founders to take our money alongside instead of, or at least alongside most of these guys out there. And that has changed too. I think enough people had that obvious realization that they're like, VC kind of sucks. Like, let's go start a firm and be the VC that we wish we had when we were raising capital. And I do think a lot of it has really changed. VCs are just nicer on average than they were when I got into it. But that first fund, it was like, hey, I've demonstrated some success, you know, returning 4 times my angel portfolio, but I'm out, you know, I'm out of my own money. And at the time I hadn't exited. That was on paper. So it's not like I could keep investing my own funds. And I said, wouldn't it kind of be a shame for me to stop if presumably I'm only getting better at this? And I thought maybe I'd raise like $2 million and front load the fees and go drive for a Lyft while I waited for markups or something, or get a different job. And that first fund, I actually, because I knew there was a reasonable chance that I wouldn't be able to raise another fund, or I would have found out that I was, you know, bad at it. Then what I did is I only had management fees for 3 years because I kind of wanted an excuse to like be able to move on and do something different after 3 years, and still with like a net fee load of 6% in that first fund. And I even had lower carry because I was like, the only thing that matters is having money to invest. And like, I've only made 11 investments and one's okay. Like, I need some advantage here. And so I dropped my carry, dramatically dropped management fees, and it still took a little over a year to raise $4.5 million.
You're saying you met 80 VCs, 4 of them you remember. What were the 4?
Oh, I remember a lot of them. I remember 4 of them fondly. I mean, they were just like, they're these ridiculous experiences that any founders listening are going to like be grinning or laughing or cringing as I say this, because it'll be so familiar. Like we made the trek down to Sand Hill Road. God forbid they would leave, they would drive up to the city to meet you. They had, sort of sat in their crystal thrones and made you come to them. And we go down, we take half our day to drive to Menlo. And I live in San Francisco, and I'd probably go to New York more than I go down the peninsula. So maybe I'm, subject to this criticism now, but like, it was like this whole trek to get down there. And then we show up and we're all prepared. And this guy's sort of like, he's late to the meeting and he's flustered, and he comes in, he's like, flipping through his phone. And it's like, sorry guys, it's been a really busy day. Remind me what you do again. And like, I wanted to, if we didn't need the money so badly, I would have walked out of the meeting. And I say that just to say, like, the bar was so low.
I want to come back more to the investment philosophy, but I also want to talk about opportunity, right? So when you started Cantos 1, it sounds like there was 2 major opportunities. One, there weren't enough good VCs that are helpful to founders at that time, and that deep tech probably was underfunded, if not funded at all. So you had this maybe this personality superpower vis-a-vis the VC culture then, but you also had this area of expert. You were going to go after an area which was risky and had a lot of, depending on what part you look at, sort of frontier tech, like whether it's climate tech had its downfall in the first version of it, or other ones have had theirs in hardware, right? Maybe not enterprise, but certainly consumer. Like,
no, you're giving me too much credit. Like at the time, the bar was literally, I don't suck. And like, I hadn't gotten to deep tech yet. I was trying to learn venture capital, and, and there were some deep tech investors like, Matt Ocko coined the term deep tech earlier than that. And DCVC hadn't rebranded from Data Collective yet. They were still doing mostly AI, but they'd made a couple in deep tech investments. It just wasn't like a thing yet. And I was trying to learn about investing. And so I was like, listening to every 20-minute VC podcast and reading all the blogs and trying to meet everyone who was a VC to learn from them. And I was jotting all these notes. And now I look back at it and I'm like laughing, because I was asking like crappy VCs for advice and like taking it. And like, if you want to learn to play basketball, you don't watch high school games. You watch the best. You go watch like Jordan and Larry Bird and Steph Curry. Like, it just didn't occur to me at the time that there was like a stratification among VCs. And like, apply this to me if you're listening, like, take this with a heap of salt. I think every tweet and interview that a VC does should come with their IRR, so you can, caveat what they're saying. And our unrealized IRR is something in the low 30s, if that, gives a little context, but not liquid. So take that with a huge asterisk. And like now I kind of don't pay attention to anyone that hasn't worked at or doesn't work at Benchmark or Sequoia. Like if you're trying to be a VC, don't listen to anyone else. Don't listen to me. Go like find interviews with Don Valentine and Mike Moritz and Doug Leone and like the founders and current GPs of Benchmark. Like they are the only people you should listen to. And you realize when you listen to them that they do things a hell of a lot differently than most VCs. And sometimes it's super counterintuitive, but like that is what is required of building a business. Like as I got really interested in investing in businesses, we can talk about this, but I like obsess over moats. But not understanding that at the time, I was just trying to be nicer. And that was a differentiator, but that eroded very quickly. And, I started experimenting in deep tech with 2017 because I was listening to all these VCs and they were like, well, we don't do hardware and software has great margins and, hardware's harder and more expensive and it takes longer and it's riskier. And I was like, oh yeah. Amazing advice, writing this down. And like one of my best investments, Solugen, is a deep tech company. And I saw it 9 months before I ended up investing. And I didn't invest in the pre-seed because I wasn't investing in hardware at the time, if that gives you some context. And then I learned about where alpha comes from. And if you are going to derive returns, you have to go where others aren't fishing. Like game theory is real. And so if 95% of VCs were categorically saying they weren't investing in hardware and bio, then all of a sudden it dawned on me, I was like, wait, that might be the best place to invest. It's like cheating if you can figure out how to do it.
Let me give you another question then. Today, right now, May 2023, you had to start a brand new fund today. What would be the alpha of that strategy?
Oh, I still think it's early stage deep tech. And it's gotten more popular, but I actually don't think most people understand how to do it. And I say that because I've been doing it wrong a lot of the time. And like, I'm still learning by doing, but there are a lot of folks that go into deep tech investing and they think that you can just rotely apply all the lessons that you learn from software. And there are some that apply, but there's a lot that don't. And one of the reasons that we don't categorically invest in pure software anymore is because it's totally different to predominantly take technical risk versus market risk. There's a lot that changes. And I became convinced at a certain point that if we tried to do both, we'd be at best okay at one of them. Like, I want to be one of the best in the world, if not the best firm in the world for early stage hardware and bio founders to come to. And to do that is going to require focus. And so people look at me like I'm crazy when I say we don't invest in software. Like, my greatest mentor who's been in venture capital for 50 years and started when you were mostly investing in hardware, he's getting old and kind of forgets that I focus on this now. And when I remind him we don't do software anymore, he looks like I slapped him and is like, well, that's stupid. But you kind of have to be doing things that most people think are stupid if you want to like produce generational returns.
And in terms of deep tech, right? I know that you have some advisors to the company, sort of listed on the site, and you've got a team now that you've built over time as you've added funds. But how can you diligence so many different areas so often? I mean, it's not like, oh well, I get SaaS, right? It's every one of the deals you've done seems like it needs a different expert to have come in and help you.
So we have 10, 11 advisors who are technical founders that I backed in funds 1 and 2, who are advisors to fund 3. So that there's no conflict there. And importantly, they are technical entrepreneurs. A trap that you can get yourselves in is if you ask quote unquote experts to do technical diligence for you. There's 2 things that are happening. One is that experts are definitionally trained on the status quo, when the biggest companies profoundly challenge the status quo. And so there's a dissonance there where like, they're going to probably tell you that it's not going to work or dumb or whatever. The other thing is that, again, going back to the probabilistic nature of this asset class, you're dealing with high variance, low probability outcomes, whereas PhDs are trained thoroughly to like nitpick every detail and find every little thing that could go wrong and tell you why it won't work. And their job is essentially to point out the fact that it's unlikely to work, generally speaking. I know it won't work. Don't tell me that. Like, help me figure out, is there a violation of physics that's going on? Like, is it theoretically possible? Sometimes I'll stipulate. I won't ask them, what do you think about this? Or do you think it's going to work? Or do you think this is, God forbid, do you think this is a good investment? Don't listen. They're scientists. They're not investors. You want to know, like, what flaw is there in their rationale? Like, is this theoretically possible? Because we're dealing, again, with like single digit probabilities, which they're not trained on. So you kind of have to reframe it. And then once we know that there's no violation of physics, I'm like, all right, get out of here. We're going to go talk to him about the business. Because the other trap in deep tech, especially, and I see a lot of my peers doing this, and I was tempted to do this for a time because I had a lot of insecurity about having a bachelor's in political science and figuring out deep tech, is to pad the partnership with PhDs. And they can help you in their areas of domain if they like get themselves out of that academic risk averse training. But the fundamental thing that we are investing in is businesses. We don't invest in technology. We invest in businesses, and technology can be a means to that end, but they are a means. And to treat technology as though it is in itself inherently valuable, and I'm speaking from an economic perspective, is idiotic. Like, I actually don't care that much about IP. You got to know, is a business going to work? And that is more about the leadership, the market, the unit economics, the sustainable competitive advantage that you can build over time, which all might be predicated on the technology, but it's like a thin slice that all the value sits on top of.
How quickly does it take you now, and maybe did it take you then, to understand the founder in a way that you earned the trust, or you realized that you didn't want to work with them? Like founder evaluation.
Like, they have to be technically competent. They have to be an incredible leader, the ability to inspire and manage others and have a like talent gravity. If success is obviously a multivariable equation, but if you force me to index only on one variable, I would say gravitas, like, or talent gravity is maybe a way to put that. Can they recruit and retain the best talent out there? Can they attract partners and talent and customers in a way that is itself differentiated? Because startups always get hard, there has to be some like pathological drive or near pathological drive behind them. And again, going back to like studying the best, Mike Moritz would say sometimes that, or allegedly he would stop founders sometimes in the pitch and say, all right, let's stop talking about the business. I want to know what happened to you before you turned 17 that formed your psyche. It was like, you got to go deep with them and really understand what drives them, what gets them out of bed in the morning. And I think I understand this better as I have come to understand my own reasons, which are like rooted in childhood and near pathological in their nature. Specifically, I lost my dad when I was really young, and facing mortality at that age imprints a hard deadline in your psyche that like is hard to ignore. And I think about my death regularly, probably more than is healthy. But it has a way of clarifying things. Like, I only have so much time, and I have to focus, and I'm determined to be part of something that I'm proud of on my deathbed when I'm on my way out. And so something like that, knowing that about myself, I kind of look for whatever it is in the founder. And if I don't understand why they are doing this at its most basic level, then like they're just another entrepreneur that like heard raising money was easy and they're probably going to quit, and they're certainly not going to build a $10 to $100 billion company that changes the world and I'll put on my epitaph.
Let's jump in a little bit more on some advice to founders right now. So first of all, where do you see the market in funding for your companies? Many of them are probably, some of them just raised, actually. I saw Radiant. What's happening in the market maybe May 2023 that's different than December 2022?
Yeah, I mean, it's been hard for a while. I think the difference is, like, if you talk to the founders, they're like, VCs aren't investing right now. If you talk to the investors, they're like, prices are too high. And like, if that's the detente, that it isn't that there's not money there, it's that there's the bid-ask spread is too wide, then like, and one side, the founders, have limited runway, and we, the investors, have management fees for a decade, guess who wins in a like duration battle? So all that needs to happen is founders need to realize that like prices have retraded. And once that clearing price is found a lot lower than it was a year ago, liquidity will open back up. And so if you're a founder listening to this and you're like frustrated that VCs aren't investing right now, know that they will if you lower your valuation. But no one wants to do that because it kind of, their friends tell them down rounds are evil. And I don't know. I think just the people aren't going to have the luxury of waiting. Everyone's been sort of, if entrepreneurs are like, well, I'm not going to raise because, I just need to wait and then ZERP will come back. Like, it's not coming back I would be willing to bet a lot the next decade, and I'd be willing to bet a little that like we won't go back to zero rate interest environments in my lifetime. And I'm 35. Like that was an unprecedented capital abundant environment that is never coming back. Get that into your head now and adjust for it. I'm sorry. I wish it was. I wish we had some big exits. We didn't. But prices have come down. Build value with the clearing price that you can achieve today, and don't over focus on valuation because you'll run yourself right off a cliff.
Yeah, it makes sense. And then what do you see for when do you see, let's just say, look, moving forward in terms of the market for founders in the areas that you're going after, do you see anything there are any particular milestones of inflection coming up? So for example, we know about the interest rates changing. We know about Biden's Inflation Reduction Act. Sort of these are moments. Do you see any of those coming up that you're guiding your founders towards, or they're guiding you towards as moments that are either going to be positive or potentially disruptive?
The IRA is a big deal. There's a lot of tailwinds there. But that's such a consensus view as to start to make me nervous. I actually think that there are aspects of that bill that were impressively bipartisan, sort of like thematically Democrat, but geographically Republican, which I think is a nice compromise. You see a lot of the money going to red states and rural areas. And so there are going to be certain things that are going to be hard to roll back, but should the Republicans win the White House next year, which I think is probably likely at this point, not that I enjoy making that prediction, they're going to come for parts of the IRA. Like you betcha. You already see them making such noise about, coming after ESG. They're going to come for some of the subsidies. Like I am convinced of it. And so I don't know that the IRA is infinitely reliable. There's aspects of it that are, like the 45Q point source capture is a good example, because that credit is essentially meant for fossil fuel burning plants. So the oil and gas industry loves that. They're getting incentivized to, add some contraptions and capture CO2. So that, Republicans might make noise about it, but that sort of thing, they're not going to roll back. Subsidies are really hard to take away. Look at the ethanol subsidy. But I don't know. I think there's going to be certain incentives that they come for that I wouldn't want to underwrite to.
Yeah.
Because that might be a negative one. A positive one on we do some stuff in sort of dual use defense tech, aerospace, and the Putin's war in Ukraine has reminded us that maybe we do need a military and advanced military technologies, and offensive technologies are often the best way to deter conflict, as counterintuitive as that can seem. And so there's a lot of emphasis on technology into our armed forces and getting the best technology in the hands of the warfighter or the potential warfighter. And so those are major tailwinds and are relatively bipartisan now, or I don't know, it's kind of funny. It's flipped. The Democrats seem to be more, pro-Ukraine than the Republicans do, but it's still, investing in defense technology is relatively bipartisan. So it kind of depends on the area. And it's a reason I'm glad that we don't focus on any one of these areas. We can kind of tack and turn depending on the environment.
Makes sense. Well, today's been amazing, Ian. We could talk for another hour, but as we wind it down, first of all, I want to thank you for your time today. And
totally, I love this stuff. I've learned a lot the hard way, so I like helping other people avoid some of my mistakes. Hopefully,
what's like bullshit right now? What's things that people should be worried about from a founder perspective, from a venture perspective, from a industry watcher perspective?
I feel like there's a lot of people that are like idealists out there, and like I don't know, we've got a portfolio company, for instance, that's like decarbonizing an industrial process by 85%, and this is one of the most CO2 emitting industries on the planet. And there's a lot of climate tech firms out there that are like, can't invest. It's not 100. And I'm like, what are you smoking? Like, Did you hear what we just said? Like 85% reduction in CO2 emissions. And like, we'll get to 100, but we can't do it economically viably in the next 5, 6, 7 years. Like, we'll get there. And they're just like, no, sorry, got to be 100. You got to use hydrogen today, even though it's way too expensive. Like, it's just, I want to pull my hair out that they're like so idealist that they're going to like have us emit more CO2 because less isn't good enough. It just gets me heated.
Yeah, it's a great one. I also see that like there seems to be a lot of innovation coming to making the oil and gas industry run in a more clean way. And that's completely poo-pooed by a lot of investors and funds. Mm-hmm. They're just like, hey, it's either kill them or die trying. I don't know if you see that. It just seems like another odd part of the climate.
Yeah, totally. Or people that are like, we have an investment in using AI and some automation for metals exploration. And they're like, oh, well, like, mining tailings are bad. And like, it has a local environmental footprint. I'm like, where the heck do you think the battery in your phone and car came from? Like, get out of here. Like, we can't just magically pull all the lithium and copper we need for the energy transition out of seawater tomorrow. Like, there have to be transitionary technologies. And like, if you really understand the scale of the problem, you're going to realize we need to pull more metal out of the ground faster. And yes, we need to be conscious of native populations and local environments. And like, ideally you do this in a way that isn't leaving toxic tailings all over the place. There's ways to improve the status quo, but like saying we're going to pull it all out of the water soon enough to matter is just completely idiotic.
What's sort of a narrative that's happening right now that you're seeing, at least in the press or maybe on social media, that you just think is completely over-indexed in terms of like, reality versus perception?
Fusion energy. I've looked at a lot of fusion companies, and I've followed some of them for over a decade, and the scientific advancements are so impressive and laudable, and we should be I believe in investing in basic research. Absolutely. I hope Cantos makes enough money someday that we can say we're going to give 10% or more of it to funding basic research. I think it's so important, but we're getting to the point that like we need to decarbonize ASAP if we want any, 1.5 degrees is gone. Like, we need to get that out of our minds. It's too late. We screwed the pooch on that one. Like, if we want any shot at keeping temperature rise to under two degrees, then we need to decarbonize as quickly as possible. And a technology that's likely not going to be commercial for, I think, still 15 to 20 years is dead on arrival. It's just not going to help in a time scale that matters. I'm sorry. Like, I wish that wasn't the case, but like, that's the reality. And yes, the science might get there, but then you need to like make it commercially viable. And we talk about commercially, everyone talks about Q greater than 1 and net energy gain is like this big thing. And like NIF kind of like technically got there, but it was the amount of amount of energy that came out of the plasma minus the amount of energy that went into the plasma. In fine print at the bottom was like 50 times, 100 times more energy went into the facility than made it into the plasma. And then you need to transfer that thermal energy into electricity, which is at best 50% efficient. So like we're saying we're 100 to 200 times away from commercially viable Q values. And like, it's not getting to Q greater than 1 theoretically. It's like actual facility level Q values of like greater than 10 is probably what you need. And that, not to mention then getting approval and building enough of these plants to matter, that scale is, I think, 20, 25 years away. And so it's just not going to matter. Like, sorry, we should invest in it, but so much money has gone into it. I think it's been actually a distraction for nearer term solutions. And call me crazy, but I think, we should just be using uranium. And there's a lot of ways to use it better, to recycle it, to have less waste, to get more energy out of it, to make the footprint smaller. And that technology we could bring online next year if we wanted to. We just need the political will. And I think that's changing. But if you want to decarbonize the grid fast enough to matter, you got to invest in fission. There's no other way. It's not to say we don't need solar and wind plus storage. Combining those two gets you a lot of the way there too. We need all of it. But I think fusion is getting to the point it's a distraction.
Excellent. Thank you for the time today, Ian. Cantos.vc. Check out Ian on Twitter as well and other places. And we'll be back next week with more.
Well, that's all for this week's episode of Climb by VSC. Thank you so much for watching and listening. Special thanks to Credo for their help in producing and promoting this episode. To visit any part of today's conversation again, you can find the full transcript on vscventures.com. Our thanks to Josue Ramiro for posting these every week. Lastly, if you've listened this far, please leave us a rating on Spotify or review on iTunes. It only takes a few seconds, really helps us out, and as far as I know, it's still carbon neutral. Well, that's all for now. We'll see you all next week on Climb by VSC.